Howdy, everybody. Welcome to Liberty Call. Today is, what day is this? It's Wednesday, March 19th, 2025. Hope you're having a fantastical day in the interwebs. It's a snowy day here in Colorado. It's supposed to have a trace of snow overnight. We got more than a trace. I mean, it's melting off the driveway, which is nice. So I need to go out and clear the walkway up to the front door and knock it off the car so it doesn't freeze again. So anyways, hope you're having a wonderful day out there. It's Fed meeting day, which is always exciting. So markets are rallying after the Federal Reserve decided to hold interest rates steady at 4.25 and 4.5, citing growing economic uncertainty. Really shocking. The S&P 500 is up about 1.1%. The Dow climbed 0.9%, and NASDAQ was leading with a 1.4% gain. Meanwhile, trade tensions with Canada continue to fuel inflation concerns. NVIDIA is making headlines with a new GM partnership, and Morgan Stanley is cutting 2,000 jobs, plus Signet Jewelers is shining with strong earnings. So before we break all the news down, I need some help from you out there in interweb land. Could you give me some thumbs up, a like, a share, subscribe, a follow, and press that notification bell. All righty. Well, let's jump into said markets. There we go. All right. Get to the Dow Jones. It was up 0.92%, 383 points, closed at 41,964. S&P 500 up 1.08%, 60 points, closed at 5675. NASDAQ up 1.41%, 246 points, closed at 17,750. The VIX was down 8.34% today. It's at 1989. Not a bad year. That was my freshman year of high school. Let's see here. Canada up 1.47, Brazil up 0.79, and Mexico up 0.54. In Europe, Germany was down 0.34, the UK flat up 0.02, France up 0.7, Netherlands up 0.96, Spain up 0.4, Italy up 0.45. We got a couple of reds here. Switzerland down 0.02, and Portugal down a third. Russian exchange is red today. MOEX down 0.83, RTSI down 2.44, and the overnight markets, the Nikkei in Japan was down 0.25%, Australia down 0.41, New Zealand down 0.63. In China, the Shanghai was down 1/10, Shenzhen Component down 0.32, China A50 up 0.75%, DJ Shanghai down 0.12, Hang Seng up 0.12, and Taiwan weighted up 0.69%. All right. Good stuff. All righty. Well, let's hop into the market recap. S&P 500 closes higher as Fed maintains a rate cut forecast. So they're still promising that they're going to lower rates at some point during the year. The Federal Reserve left interest rates unchanged at 4.25 to 4.5, maintaining its forecast for 2 rate cuts this year, despite acknowledging a tougher inflation battle. Well, see, if they only can lower rate, well, really they have 2 reasons that they can lower rates. A, inflation is just bottoms out, and they can lower rates to try and get inflation to come back up a little bit. Let's say inflation goes down into negative territory, which I don't foresee happening, or we have some sort of a black swan event, markets collapse, which there's a pretty good possibility that could happen since we haven't really had one of those since 2008. So those are really the only 2 circumstances where they would have justification to actually lower rates. Lowering rates last year, I think that was more of just trying to placate the current administration in office and make sure that they wouldn't get the blame, if they got voted out. Well, let's see. All right. Where were we here? The central bank now expects higher inflation this year, but Fed Chair Jerome Powell suggested that weaker economic growth could help balance inflationary pressures. The rate outlook for 26 and 27 remained unchanged at 3.4 and 3.1% respectively. Yeah, that's still way above the 2% target. All right. The Fed's decision reassured markets, sending the S&P 500 higher, with investors betting on a looser monetary policy ahead. Corporate highlights, Tesla jumped 4% after securing a key regulatory approval in California for its long-awaited robo-taxi service, marking a significant step forward or toward autonomous ride-hailing operations. I don't know about you, but I saw Total Recall when I was a kid back in the late 80s. I'm not getting in a car run by a machine. I'm sorry. I mean, I don't have a problem with autopilot where I'm behind the wheel and I can take control where, if things start to, go the wrong way or you hit, slick road conditions or whatever. But a robot driving it, no, and I'm in the back seat and have no, can't do anything. I don't think so. Not today. Maybe in 20 years, we'll see. Boeing surged 7% after as CFO Brian West highlighted improving operational performance, easing investor concerns after months of turbulence. NVIDIA gained 2% with CEO Jensen Huang dismissed the concerns over tariffs, stating that they wouldn't have a meaningful near-term impact on the company. And General Mills dropped 2%, warning of declining annual sales and profits due to increased competition from lower-cost private label brands. Probably because they put all that nasty dyes and chemicals in their food. That would be my takeaway from that. But, markets cheered the Fed's stance despite the inflation concerns. Meanwhile, Tesla's robo-taxi dreams, Boeing's recovery, and NVIDIA's AI dominance are keeping investors bullish. But let's not get too comfortable. Powell still has a tightrope to walk. That is true. All right, next up. Got some data here. U.S. crude inventories rise, surpassing forecast and previous figures. All right, larger than expected inventory build raises market concerns. The latest EIA crude oil inventories report revealed a significant increase of 1.745 million barrels, surpassing the forecasted 0.8 million barrels and the previous month's 1.448 million barrels. This unexpected rise suggests weaker demand, a bearish signal for oil prices. So what's the market impact? Higher crude inventories typically indicate lower immediate demand, which can push oil prices downward. Since energy costs are a key input for various industries, declining oil prices could help ease inflationary pressures in the short term. And actually, oil has actually been pretty decent the last year. It was we had deflation last year for a good part of the year, and on a 12-month rolling return, energy inflation is only up 1% right now. So all in all, that's really helped. I imagine, those of us who live a little in the northern part of the country, who use up a lot of oil and gas to keep our homes warm and to cook and all that good stuff. It's been a nice respite from, some years where those prices really get high. Possible reasons for the increase: demand weakness, a slowdown in economic activity, shifts towards renewables, or seasonal travel declines may be reducing consumption. Supply surge, increased domestic production, or higher imports could also be contributing to the inventory build. So what's next? While a single data point doesn't confirm a broader trend, this report will keep analysts watching for signs of sustained demand weakness. Future inventory reports will be crucial in determining whether this is a temporary fluctuation or a longer-term shift in the oil market. Oil bulls will not be happy, but cheaper crude could offer some relief at the pump. Just don't expect the government to take credit for it. All right. So yeah, I mean, that's kind of been my advice with clients of late during our meetings is that, it's nice that we've been getting some relief at, the gas pump or, your propane bills or your, whatever they might, or natural gas bills. But I'm an investor too, and I like oil and gas stocks. They usually pay good dividends. And so them not doing great right now is kind of a double-edged sword. All right, last up from Zero Hedge, Fed holds rates, signals QT taper, blames Trump uncertainty for stagflation outlook. So it's always Trump's fault. All right, as expected, the Federal Reserve kept interest rates steady at 4.25 to 4.5, but the real news was the downward revision in economic growth forecasts and upward adjustments in inflation and unemployment projections. A classic stagflationary warning. GDP growth for 2025 was cut from 2.1 down to 1.7, while core PCE inflation is now expected to hit 2.8%, up from 2.5%. Unemployment is also expected to tick up to 4.4%. And I imagine that, kind of how the dominoes or the Rube Goldberg machine will flow is first we'll see consumer spending falter, and as it goes up, as it goes this way, it'll like flatten out and tip over. And then the next shoe to drop would be jobs, because as revenues fall at your service businesses, things like that, they're going to cut payroll to be able to stay afloat. Then you'll see higher unemployment numbers, and then as it trickles into like the industries, where goods and services, it may take a little while to get out into the manufacturing sectors. All right, where was I? All right, here we are. Fed Chair Jerome Powell admitted that tariffs are already affecting the economy and have been factored into projections. However, he maintained that their inflationary impact is transitory. Hey, there's that word again. Remember when Janet Yellen said that back in the May of 2022? Frustrating the left-leaning press. Powell downplayed the rising long-term inflation expectations, but acknowledged that economic uncertainty has increased significantly. Despite keeping the two-cut forecast for this year, the dot plot revealed a more hawkish tilt. More members now expect just 1 or 0 cuts this year, and no one expects 4 cuts or more. The Fed will slow its balance sheet reduction, the quantitative tapering or tightening, starting in April, cutting monthly Treasury runoffs from 25 billion down to 5. Remember, they were, I think, 50 billion, and then they cut that in half. So they're really slowing their taper because they're trying to keep. It seems like they're trying to keep inflation high. But hey, what do I know? Markets initially rallied as investors saw a slightly more dovish Fed than expected. The S&P 500 jumped 1.3%, while 2-year yields dropped 6 basis points. Gold surged while oil and stocks struggled in recent weeks. The Fed is playing the waiting game, but stagflation risks are rising. Rate cuts are still on the table, but don't bet on the Fed riding to the rescue anytime soon. So, yeah, probably. I mean, for the Fed to come in and just slash rates to 0, which I know a lot of people would like, it's going to take something really bad happening like we had in 2008, like what we were leading into in 2020. Most people forget that all that COVID stimulus, that papered over the economy. Most people didn't have any clue that we were headed into a recession, that we'd had a inverted yield curve the year before, that the reverse repo markets were a disaster in the fall of 2019. So, the average person, unless they listen to me on a regular basis, had no clue what was going on. So anyways, all right. Well, that's everything that I was going to cover for today. So it's good stuff, wasn't it? All right. So if anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. Give me a call. I'd be glad to help. All right. Well, hope everyone out there has a wonderful evening, and I'll talk to everyone again next time. Adios.